everyone. I am Bernard Young, President of ABFEL. I would like to welcome you all to our academic keynote by Professor Amit Seru of Stanford and ABFEL on modern banking system implications for stabilization policies, moderated by NUS Business School's Dean, Professor Andy Rose. I sincerely wish that we were able to do this session in person. Still, I thank you all for zooming in. Your participation amid the pandemic is very endearing to us all. Before introducing our chair of the event, I would like to thank GIC for sponsoring this event. ABF Yao is very grateful to GICs for its generous support, and I also want to thank the ABF Yao team's effort in managing this event. Now, let me introduce the chair and the moderator of this keynote. It gives me great pleasure to introduce Dean Andy Rose and Distinguished Professor of NUS. Andy became the Dean of NUS Business School in June 2019. He has been doing an excellent job guiding us smoothly through the pandemic, expanding our recruitment and also expanding our programs. Prior to joining NUS, Andy served as Associate Dean for Academic Affairs and Chair of the Faculty at Berkeley from 2010 to 2016, the Hess School of Business. He is also a Research Associate of the NBEL, a Research Fellow of the CEPL, and a Senior Fellow of the ABFEL. He was the founding director of the Clayson Center for International Business and Policy at HATS, and also the Risk Management Institute at NUS. Andy's widely cited research addresses many important issues in international trade, finance, and macroeconomics, appearing in top finance and economics journal. Andy has served and advised multiple important institutions, including the IMF, the World Bank, the ADB, the central bank in Australia, Canada, England, Europe, Hong Kong, Singapore, and the US. We're very lucky to have you, Andy, and in spite of your very busy time, you're having us here to moderate this session, and thank you very much. And so without further ado, let me pass the floor to our Dean, Andy Rose.
Thanks, Bernie. I really appreciate it. As you all know, Bernie is the essence of ABFER, and lest there be any doubt, ABFER is the way it's pronounced, not ABFER. And the reason is because ABFER aspires to compete successfully with NBER and CEPR, so hence the similarity. I'm extremely happy to be here. I add my welcome to all of you to not only this session, but to ABFER events this week and also next week. It's a pleasure that we can meet virtually. It would be better if we could meet in person, but such is life. Okay, I'm going to be brief because I'm not the reason why you're at this session. The format for this will be very straightforward. Amit's going to speak for 40 minutes to do a presentation. That should leave us with about 20 minutes afterwards. If you want to pose a question, there are two easy ways to do it. There's either the chat function in Zoom or the Q&A function in Zoom. I will be monitoring both of them. Some people, it's not exactly clear who can raise their hands, but I urge you to either use the chat function or the Q&A. Okay, now just a little bit about Amit. You all know him. That's the reason why you're here. He is clearly a superstar. He's a longtime member of both NBER and CEPR. He started off at Chicago Booth. He's published up a storm. And since leaving Chicago, he's gone to some obscure business school on the wrong side of San Francisco Bay, but we won't hold that against him. Amit, the floor is yours. It's a pleasure to have you with us, and entertain us now and teach us something about the modern banking system.
Thanks, Andy, and thanks, Bernie and others for inviting me for giving this keynote. I'm looking forward to interacting with you all, and thank you for joining. So what I thought I'll do is talk about some of the work that I've been doing with several of my colleagues over the last few years And the title is a little bit provocative: Modern Banking System and Implications for Stabilization Policies. There are lots of implications, but I'll keep my remarks down to a few things. A couple of caveats here. The first is that I'm going to be talking about the banks in the context of consumer credit markets. But that's not to say that many of the things that I'm going to be mentioning are not relevant for banks in general, which means thinking beyond consumer credit, thinking about firm credit. Many of the same principles apply. I also am going to be speaking about most of the analysis that's been done using US data. But again, the implications are more general than that, and we can chat about it later, hopefully during a Q&A. So again, thanks to the organizers for inviting me, and it's a real pleasure. Though I agree with Bernie and Andy that it would have been great if we could have done it in person, but hopefully soon. All right, so let me set the context. When we think about stabilization policies and the role of financial intermediaries, one way in which we have thought about these things is there are a bunch of these shocks and policies that we have as our levers. Think about interest rates, monetary policy, capital regulation, debt relief policies, other policies that affect the secondary market, for example. And the reason why we are interested in using these policies is because from time to time, we might need to pass these to the consumer or the firm sector. And most of this pass-through happens through banks. And that's the traditional classic view that there are banks in the middle. There are these policies. We got to figure out how to get these policies into the consumer or firm sector. And because we are interested in tracking some outcomes like credit supply, the distribution of credit, defaults, foreclosures, if it's consumer sector, consumer spending, if it's firms, it's firm investment, things like house prices, employment, and so on. And the starting point here is to argue that I'll present you three sets of facts, which will suggest that the classic way of thinking about this is not complete. And that's the reason why I sort of call it modern banking system. Now, what do I have in mind? The middle piece here requires a little bit of tinkering, and this comes from both the research that happened in the aftermath of the Great Recession in 2007 and ever since, whatever we have learned. So the way you want to sort of think about it is there are households, of course, which are quite important here. We have realized that the balance sheet situation of households is important. The distribution of household leverage is important in the economy. I'm not going to be talking about that, but obviously that's an important piece here that we can't forget. What I'm going to be speaking a lot about is intermediaries, and our understanding of intermediaries has gone quite a bit from just the classic view, and I'll elaborate on what I have in mind. So things like, are we talking about banks or are we talking about non-banks, also known as shadow banks in some part of the world? These are non-depository institutions. Are we talking about those which rely on a lot of technology like fintech or non-fintech? And what kind of organizational capacity do they have to do different kinds of activities like refinancing or debt restructuring or even origination? Because all of these things we have realized do matter for how the policies are passed through. And there is also an interaction with the type of contracts that intermediaries sign with households. So are these contracts that are in the private market, or is there a government intervention that's associated with these contracts, because that moderates the policies very differently? Are these contracts kept on bank balance sheet, or are they sold in the secondary market? Because that has very different implication. Are these contracts, fixed interest rate contracts, or variable interest rate contracts? Again, those have very different implications for policy pass-through. And obviously, intermediaries and loan types interact with the type of households, which, as I said, we are not going to be talking about right now. So the ones in yellow are the ones, the topics that I will be focused on today. And what I'm going to try to argue is that, look, when you think about intermediaries, you've got to worry about the industrial organization of the credit market. That depends on the type of intermediaries. That depends on the type of contracts that are being written between intermediaries and households, and the business model of different intermediaries, because they are not the same. And if they are not the same, you've got to worry a lot about competition in ways that we have typically not done, like I told you in the classic setting. And once you sort of do all this and start thinking about how it interacts with household balance sheets, the way we think about policy changes quite a bit. The way we think about stabilization policies changes quite a bit. And that's what I'm going to be trying to convince you, that we want to expand our thinking of the way we have thought about policy, because that doesn't apply anymore to the way credit is moderated in the economy. Now, when I will be talking about all of this, I already gave you two caveats about US-centric and consumer credit being the center of what I'm going to be showing you. There is another caveat that I wanted to sort of say, that I'll be talking about just a few policies, not all of them. We can talk about others if there is more time, but for the talk, I'll mainly be focused on monetary policy, the QE sort of monetary policy. I'll be interested in talking about capital regulation, and I'll be talking about debt relief policies. These are the stabilization policies that I will be spending most time on. And if I think about the outcomes, I'll be mainly talking about credit supply, the distribution of credit supply, and the defaults and foreclosures. That's not to say that other things are not relevant or don't matter, but I have limited time. The other caveat that I want to sort of throw out there, and maybe this comes up in the Q&A, is that if you think about modern banks and the banking system, it's not just what I'm talking about that we need to worry about. I mean, what I'm going to be talking about is just one step towards understanding how intermediation is changing in a big way. So if I, again, focus on US and I think about what's been happening to banks, each of the activity that they do on the asset side, from lending, payments, wealth management, treasury and investment banking, has been disrupted by a bunch of players that, I've listed some of them. I'll be mainly talking again only about lending, not to say that payments, wealth management, and other things are not happening. And those things also can interact with the kind of things that I'm talking about in ways that will affect how stabilization policies or regulation gets moderated in the economy. So something to keep in back of your mind if you're thinking about the big picture. All right, so what's the why do we need this new view? Well, let's start with the classic view of bank balance sheet. What's the idea that, hey, banks take deposits, from deposits they make loans, they do the asset maturity transformation. And you really, when we think about regulation or monetary policy pass-through, we are thinking about banks from the perspective of this trade-off at the back of our mind, which is, hey, they need to keep some capital because we want to maintain stability of banks. Banks, if they go down, there are externalities. So we want to make sure that they have enough capital. That's the stability concern. But of course, we trade that off against whether that might actually affect real economic activity. So whenever we are interested in doing some sort of stabilization, we tweak around with these capital requirements because that affects bank lending, it affects rates, and so on. And what I'm going to be sort of trying to argue very quickly is that, look, you got to expand this view quite dramatically because there are three facts out there which over the last decade and a half make this classic view quite redundant. So the first couple of facts are around the fact that, hey, look, there are these entities known as shadow banks, which have become pretty big players in consumer credit, also in the loan market to corporates, actually. So you're talking about entities that are non-banks, they don't take deposits, so they're not regulated like banks. Some of them rely a lot on technology, so they are fintech, but not all of them do that. And there has been a lot of growth in this sector, and we need to understand this. So I'm going to show you some facts which will tell you that we need to worry about these things. And the way in which people have thought about how they can incorporate this is a little bit incomplete, and I'll get to why that's the case. So what are the facts? Well, if you think about different kinds of consumer segments in the US, so you can think about personal loans, you can think about mortgages, you can think about student loans, auto debt. Regardless of whichever segment you look at, there has been a tremendous growth of shadow banks, which are non-depository institutions, in the last decade and a half. Okay, so here what I have plotted is on the left-hand side, US residential mortgage market, and what's being plotted is the percentage of originations that shadow banks do, which are non-depository institutions. And all this is trying to tell you is that, hey, look, it went from 25% to 55, 60% by the end of 2017. By 18, 19, it's a similar number. And if you're wondering what kind of shadow banks are these, who are these entities? On the right-hand side, I'm giving you a snapshot of the top 10 lenders in the first quarter of 2018. And there are all the large banks that you might think about: Wells Fargo, JP Morgan, Bank of America, and so on. But so is Quicken Loans, Loan Depot, and others, which are in red. And these are shadow banks. Now, it turns out that if you look at the growth on the left-hand side, 1/3 of the growth comes from shadow banks, which are also very reliant on technology, the so-called fintech lenders. Everybody has technology, but they have technology that they rely on more than others in terms of how much activity is getting moderated by technology versus a human, potentially. So there has been tremendous growth of shadow banks, and something that is happening across the board, across the segment. So you might ask, like, why is this happening? Is this just regulation, or is this technology, or is this both? And when people think about regulation and technology, they typically think about capital costs, supervision, legal costs, because of which regulation has made sure that banks are not able to lend as much. On the technology side, the feeling is that there are lower costs, maybe better quality products, maybe better models that these new entities are bringing in, which banks are not able to compete or keep up with. And there is some evidence that you can sort of look at very quickly, which gives you some sense of regulation being important. So the whole idea here is that after the crisis in US and outside US, there was extensive regulation on banks. Regulation dampens banks lending, and because it raises the cost of lending. And once that happens, shadow banks can come and fill in these regulatory gaps. The question is, quantitatively, how large is it? Very simply, in the data, if you were interested in sort of looking at this, you can actually look inside the US and look at regions where banks have faced more regulatory burden over the last decade and a half, and see what happened to bank activity. So if you looked at consumer credit or you looked at mortgage credit, you find that banks retreat and shadow banks entered in this market. And in one of the studies with my colleagues that I mentioned earlier, we look at this and we look at the regulatory burden in different regions, in different counties, in different ways. You could look at how much capital the banks are being asked to raise in a given region. You could ask how much lawsuits are the banks that are lending in a given county are they facing? Or you could ask how much supervision are they facing in a given county, and what's happening to the bank activity. And on the y-axis, what's being plotted here is the change in shadow bank share, corresponding to whatever the regulatory pressure is. So the idea is that banks are exposed to some national level regulatory shocks. Regions, counties are exposed to these shocks based on some starting point lending market share, say 2008 lending market share. And then county level variation comes from differential exposure to differentially shocked banks. And then what you see here is that shadow banks are entering wherever the exposure or regulatory burden on banks is higher. So regulation clearly has some role, it seems, in where shadow banks expanded in this time period. What about technology? Like I said, when it comes to technology, people think about fintech lenders in particular. And the idea is that, hey, look, they have data advantage, they have other advantage, which allows them to offer better quality. And maybe they can target some segments more quicker, easier, like refinancing segment. Why refinancing segment? Because refinancing is a sector where you already have information about the firm or the household. So you don't have to go out and collect new information. It's already there in the system. So if you are technologically savvy, you can draw down that information and use it. And if you offer better quality, you could even be charging for convenience, for example. So if you look at data, for example, again, in the mortgage space, and you look at a traditional lender, and you look at a fintech lender like Quicken Loans, what do you find? You find that Quicken Loans is doing way more refinancing relative to a traditional bank. And this is true for all fintech lenders, not just Quicken, but I'm just sort of showing you this to give you the stark sense of where they are skewed in terms of their activity. What about the fact that they are just looking at measuring risk better than other lenders? So if you look at the data, and maybe this is just a manifestation that the last 10 years we haven't seen that many defaults barring the COVID time period, you don't see much in terms of fintech lenders and traditional lenders screening risk differently. They seem to be screening risk similarly. One difference where the fintech lenders are very different from traditional lenders and also non-fintech shadow banks, because remember, shadow banks are non-depository institutions, and there are two kinds: fintech, which rely on technology, and non-fintech. So fintech lenders are different from non-fintech shadow banks and traditional banks in that they are also screening on willingness to pay of consumers, not just on risk. And you can, for example, see that they are able to offer products which are more convenient. So they have identified a segment where people are willing to pay a higher price for convenience. So if you can offer a better product, a different product, which the consumers need, they are going to charge more. So for example, here is a picture of what Quicken charges its borrowers relative to a traditional bank again. And you can see that Quicken persistently charges a higher price relative to traditional bank. And you know, in the paper, we sort of do more and try to convince you that this is because they're offering a different kind of product, a better product, a higher quality product. So there is both evidence for regulation and technology playing a role, but you know, quantitatively, how do we sort of say anything about this? So in some of the work, what we do is we try to quantitatively go after this question. How do we do that? Well, you got to quantitatively take seriously the demand side, which is how are the households deciding what product to go after? And when they're deciding what product to go after, how are they thinking about price? How are they thinking about non-price, which is service, branches, whatever have you? And how are they deciding between fintech and non-fintech shadow banks and banks? And from the bank side, you got to worry about, okay, you know, how are shadow banks and banks different? Well, regulatory regimes are quite different. How are fintech shadow banks and non-fintech shadow banks different? Well, technology is different. And so how are they offering products? What are the costs that they have and so on? So we model this. And the key moments in the data which help us discipline the model are the following. There are two key moments in the data. One is you make the comparison between banks and shadow banks. And what's the idea? That everything else the same, if you look at prices and quantities, which is market shares of these two entities, banks versus shadow banks, any differences that you see, if the price is the same and market share moves, is attributed to regulation on banks versus shadow banks, because shadow banks don't face regulations, banks do. The other key moment in the data which allows us to discipline the model is when you look within shadow banks and compare fintechs and non-fintechs. What's the idea? Again, you can look at price and quantity, which is market share and prices. And if you find that, for example, when you raise prices, the market share goes up, that tells you something about differences between fintech and non-fintech. So what's the difference between fintech and non-fintech? It's not regulation, it's technology. So any differences between these two, we can back out technology differences, quality differences, and any differences between banks and shadow banks, we can say something about technology. And when we do the decomposition, we find that about 2/3 of the growth that I showed you is because of regulation, and the rest is due to technology. So once we do this, you know, many people sort of have thought about this as, okay, fine, we understand that there are these shadow banks, okay, decomposition and so on. Now, why can't I just look at banks and whatever they do, just scale it up by whatever activity has gone to shadow banks? Because it seems very natural to think like that, hey, all shadow banks are doing is some activity is leaking into the shadow banking sector. So I look at banks and just scale it by a factor and everything is hunky-dory. Problem is we cannot do that. And that basically is related to the fact that if you think about shadow banks increase in activity, it's not uniform across segments. So what do I mean by that? So again, this is very US centric, but a big picture. If you think about the mortgage market in the US, there is a big chunk of the mortgage market, 2/3 of the market, which is government mandated. It's called the conforming market. It's a market where Freddie and Fannie Mae operate. And what that means is they are willing to buy mortgages if they conform to certain standards. And then 1/3 of the market is the private market. It's called the jumbo market. Think about these as being larger loans, which are essentially could be sold in the market. But right now, the situation is such that jumbo market is pretty illiquid in terms of secondary sales. So if you make a jumbo loan, it has to be on the balance sheet. Now, what am I showing you here? That I showed you earlier that shadow banks were increasing their market share over this time period. Now, what I have plotted here is what's happening to the corresponding bank market share, which is going to be the inverse of that. And I have plotted it separately for the two segments, the jumbo segment and conforming segment. And what this picture should basically tell you is that a big drop in banks' market share is essentially coming from the conforming market, which is the government mandated market. It's not uniform. So if you just scale up and down and say that I have understood what's happening in shadow banks, you would not be doing a great job because it's not uniform. So you can dig deeper and try to understand what's going on here. And you can sort of do this in different ways. And what I have plotted here on the left-hand side is, again, a picture where it's normalized to 1, and 1 just means on the left-hand side is the government mandated market, and on the right-hand side is the jumbo market. And the numbers here are just basically telling you how they are relative to the point at which the thresholds change. The threshold is based on loan size, and the loan size thresholds have changed over the years. So this has been rescaled, taking all that into account over the sample period that I showed you earlier. So what has been plotted here is the bank market share. So what I showed you earlier is the same thing that you see here, that the bank market share really is lower on the left-hand side, which is the government mandated side, and is much higher on the jumbo side, which is the private side. Now, what is also interesting is that the government side is easy to securitize, and the jumbo side, the private side, is hard to securitize over the time period that I'm telling you. This is not something that I'm going to argue in isolation, because if you think about on the right-hand side, hey, how much activity of is bank actually retaining on its balance sheet? So bank market share is on the left-hand side, but how much of this is retained on the balance sheet? And what you see is very similar to easy versus hard to securitize. If you look at the left-hand side of the right-hand side picture, the conforming side, you see that most of the loans are sold, very few are retained. On the right-hand side, in the jumbo side, you are essentially selling most of these, you're actually keeping most of these loans on the balance sheet. So this is something that's going to feed in to the second series of facts, which are also quite important, which is that over this time period, banks have not been static. Banks have changed their choice of business model in response potentially to the kind of changes that they were seeing with shadow banks coming in and growing the way that I have told you. So you don't want to think about the growth of shadow banks without thinking about what banks are doing. And let me sort of put more color to that. So here is what banks have been doing. So when you think about the traditional bank model, remember the classic model was you get deposits, you originate loans, and you keep on the balance sheet. That's not what is happening in the consumer credit. This is just the snapshot of mortgages, but this is a similar picture in consumer credit. In fact, it's very similar in corporate loans as well, and in auto loans and in credit loans. So whatever banks used to do, what you think they used to do, they're not doing that, in the sense that there is retention, but there's a lot of sale going on. So what have I plotted here? This is in the mortgage sector. And what is very relevant here is that the middle piece, which is sold to GSEs, that's the Freddie and Fannie of the world. So remember, those are the only players in town really who are buying mortgages, and banks are doing quite a bit of sales to these. They're retaining as well. That's not to say that retention is zero, but they are selling quite a bit of it. Now, is this sale and retention uniform across banks? Turns out it's not. So, and the way you want to think about it is that there is a spectrum of banks. If your balance sheet has capacity, it's well capitalized, you tend to both retain and maybe sell. But if your balance sheet is not very well capitalized, you're mainly into selling. Okay. So how do I sort of know that? I know that from analysis like this, where both on the left and the right-hand side on the y-axis is how much of the loans are being held on the balance sheet of the bank. And what's the x-axis? X-axis is what's the capital ratio? What's the balance sheet strength of the bank, if you will? On the left-hand side, it's across banks. and on the right-hand side, it's within the bank. And essentially what this is telling you is, as the balance sheet health improves, you retain more. And so banks retain and sell, and retention moves with their strength of their balance sheet. What about shadow banks? Well, shadow banks have a different model. Shadow banks are mainly, in the business of originating and selling. This is exactly the same picture in the same segment for shadow banks. This is mortgages. And what you see here is that there's a big difference in the middle piece. They are basically selling most of what they originate. In fact, all of what they originate to GSEs. Whatever tiny thing that you see at the bottom is mainly due to some reporting issues in the data, which we can talk about if you're interested. So the way you want to then think about the business models of banks and shadow banks is banks, well-capitalized banks are on one side of the spectrum. They both retain and sell. Shadow banks are on the other side of the spectrum. They only sell. And weakly capitalized banks are somewhere close to shadow banks. So that's the spectrum of banks out there. So once you start putting these two things together, you sort of realize in the data that all of these three things move not just the prices, but the quantities as well. So if you are interested in thinking about intermediation and regulation, you want to put these pieces together. And what does that mean? That means trying to figure out what the industrial organization is. Why do I say that? Because shadow banks, because they are in the business of originating and selling, they can only operate in parts of the segments of the market where the secondary market is pretty liquid, where there is a market where you can sell the loans. So in the case of mortgages, it's conforming loans. In the case of corporate loans, it could be certain kinds of loans and so on. So industrial organization is very important. Where are shadow banks and banks competing? And when shadow banks and banks are competing, how are fintech and non-fintech competing with banks? That's going to be extremely important. You also want to think about their business models, because banks are retaining and selling depending on their health of the balance sheet. Whereas shadow banks are all into selling. You put all of this together, you've got to think about the equilibrium, because households then are going to be picking these things, and banks and shadow banks are going to be competing. And I'm going to argue that these things matter big time in terms of how we want to think about different stabilization policies. Like I mentioned earlier, I'm going to be talking about stabilization policies that are capital requirements, secondary market intervention, and debt relief policy. So what's going to become very important in these things are two margins. One is called the shadow bank migration margin. What is this? This is the idea that, hey, look, shadow banks have low regulatory burden. They originate to distribute. So some activity will be moving to shadow banks. The other thing that's going to become very important is the traditional bank retention margin. What's the idea? That when you have the balance sheet capacity, you can outcompete shadow banks because you have low interest rate deposits, which allows you to outcompete shadow banks potentially. And the market segmentation with banks will move around depending on the capitalization. So when you take these two margins and put together in a model, you can then start studying the kind of things that I'm talking about. Again, the model, very big picture, we can't get into details, but you can read the studies that we have written on this. On the demand side, you want to think about a household with heterogeneous consumers who think about price and non-price terms. They also think about things like, am I going to be accessing different kind of market, a private market or a government mandated market, because I might have preferences on that. You can model all of those things. You can model the fact that consumers differ in demographics, their preferences might change depending on that. And we sort of do all of that. On the supply side, you got to think about, again, what kind of products are we offering? What's the price? What's the non-price? What type of lenders are there? There is going to be shadow bank fintech, shadow bank non-fintech, and banks. They are going to differ in terms of their regulatory burden. And they're also going to differ in terms of capital requirements, which only banks face. So banks typically will have an advantage in financing relative to shadow banks. But once capital requirements become binding, this advantage sort of disappears. You put this together, and we do that and sort of figure out the equilibrium. And the equilibrium then allows us to figure out the things that I was sort of mentioning. So I'm going to be talking about, for instance, capital requirements. So this is, again, one of the main tools that policymakers have to regulate banks. And let's sort of see what this kind of analysis gives us. So here is capital requirements. And you can change capital requirements and see what happens to various sorts of outcome variables, lending volume, bank stability, distribution of credit, and so on. Here, I'm going to focus only on lending volume to just give you a sense. So what do I want you to do? I want you to focus on the right-hand picture here and the baseline scenario. So let's first see what's happening in the baseline scenario. Let's say the capital is at the baseline scenario. And what I have shown you is what's the total lending volume in billions of dollars at that time. And it's been split between different sort of colors to give you a sense of where activity resides. So the starting point is the conforming market. In the conforming market, there is a part of it, a conforming, which is going to be originated by shadow banks. Shadow banks just sell to GSEs. That's why they are in the conforming part of the market. Conforming market will also see banks operating. Banks will be selling some of that to the GSEs. That's dark blue. But they'll be keeping some of that also on the balance sheet as well. That's light blue. And then there is the jumbo market. This is the market where banks can only operate. Why? Because this is not a market where shadow banks can sell to anyone. This is a private part of the market. So banks are going to be only operating in that market, and they retain everything on the balance sheet because there's nowhere to sell. So that's the starting point. Now, suppose we move from that to the right-hand side, which is we jack up the capital requirements. Now, what happens? Well, look at the colors. Essentially, there is a major change in the middle blue portion of the balance sheet. If you look at the aggregate lending, it has barely moved. Jumbo part, not moved much. Shadow bank, GSEs, not moved much. What has really moved is, as I jacked up the capital requirement, balance sheet lending became expensive, especially in the conforming market, and banks decided to become exactly like shadow banks and just sell to GSEs. Why didn't they do anything in the jumbo market? Well, because they are the only game in town, so they can pass a lot of this higher cost to the consumers who may decide they have to stick with banks because they have nowhere else to go. We can sort of do this on a much larger scale. So on the x-axis here is now taking capital requirements of different quantities and seeing what happens. And this is where the margins become quite important. So the blue dotted line is what happens in the bank balance sheet. The dark black line is what happens to the bank when you include the balance sheet and the loans they sell. And the maroon line is what happens to shadow banks. Okay. So what I first want to sort of show you is that as capital requirements are jacked up on the x-axis, what you see is that the lending on bank balance sheet goes down, which is the classic model. But that's not where you stop with banks, because banks do a lot of selling now as well. So the first margin that you want to think about is, hey, if I look at the total activity of lending that's happening in the economy, it's not just what's on the bank balance sheet, it's also what bank is selling. So the total lending drop when the capital requirements go up is not as much. But that's not all. You also have the shadow bank migration margin, because some of the activity migrates to shadow bank. And what you see here is that when you look at the total lending volume, even when you jacked up capital requirement quite a bit, it has not gone down by that much, because shadow bank migration and balance sheet retention both dampen the shock. So what about the second policy, which is, let's talk about the secondary market intervention. So we can think about that intervention also in this framework. What is this intervention? Well, this is the intervention when, let's say, Fed is purchasing some types of assets. Here, let's call them GSE mortgages. So you can think about this as QE, for example, right? And you can again do the similar kind of analysis. On the left, on the right-hand side picture, again, let's look at the total aggregate lending volume and see what happens when QE intervention happens. What does QE intervention do? QE intervention changes the cost at which these loans are going to be bought in the secondary market. So you can see 10 basis points, negative 10 basis points, and we can have a similar spectrum and see what really happens here. Sorry, I see a bunch of chats, and I'm not monitoring the chat, so I'll let Andy tell me whenever I'm heading close to my ending point.
Another 5 minutes, please.
Another 5 minutes. Okay, perfect. So in terms of lending volume, so then what do you see here? Well, if you look at the baseline and then you jack up the cost of selling to GSEs, for example, look at what the change that happens. Again, most of the change happens here in the middle blue portion. But now what we have done is we have made selling expensive. Shadow banks have no other place to go, so they stay there. But banks move from selling to balance sheet lending because they become competitive there, and jumbo loans remain the same way as they were. And you can do this over a larger spectrum. Now, again, the dotted line here is what happens in the bank balance sheet. So as you make it more expensive to sell these loans, not surprisingly, you see that bank balance sheet is where all the activity goes. In fact, if you look at bank balance sheet and selling, the selling is contracting. So all the activity is on bank balance sheet and selling goes down quite a bit. If you see what happens to shadow bank, well, secondary market interventions are very costly for shadow banks. And what you see is if you make it expensive to sell, shadow banks are going to contract quite a bit and they're going to amplify this shock. So what this has sort of told you is that if you look at capital requirements, total lending decline is much smaller because of the offsetting forces that I told you. And you want to then think about Basel requirement, for instance, across countries, because when you think about shadow banks and the secondary markets, they are different in different countries, but yet we have similar capital requirements because we are expecting similar sort of responses when it comes to total lending. It's not going to be the case. This also has implications when we think about banks versus secondary markets, because if we have a policy that affects banks directly, what you will find is that banks and shadow banks dampen the shock. But if the policy is more in the secondary market, it can have ambiguous effects and larger effects because shadow banks are affected big time when there is a secondary market change because their business model is all about selling. So they are very reliant on secondary market. The one thing which I didn't talk too much about, but hopefully we'll get a chance to talk about in the Q&A is that this has a lot of distributional effects. So for example, when capital requirements are jacked up, those who are losing out are really wealthy borrowers in high house price areas because what you're really affecting is bank balance sheet, and bank balance sheet really affects jumbo borrowers, which are wealthy borrowers. That's not always the case. It all depends on the policy. So when you think about the stability between, when you think about the trade-off between bank stability and lending, it's not as trivial as saying every borrower is going to be affected similarly. There are distributional consequences, and one can study that. So these were the two policies that I wanted to talk about. The third policy that I thought would be also relevant and useful to talk about is related to debt relief. So typically, when we think about these intermediaries, we haven't thought deeply about intermediaries mattering for debt relief. So what do I have in mind when I think about debt relief? I have things like renegotiation, modification plans, refinancing plans. In the Great Recession, there were huge, big programs passed in the US and Europe. So in US, for example, the HAMP and the HARP programs were passed. And there is a lot of work which sort of argues that intermediary frictions matter for debt relief and economic recovery. So for example, if you look at, this is one example where you're looking at auto consumption, and what is plotted on the x-axis is over time when the major debt relief programs happened. And what one finds is that regions that were more exposed to debt relief recovered much quicker than other regions. And what were the regions that were more exposed to debt relief? These were regions where intermediaries somehow were doing more of this activity. So you got intermediaries who were more able to do these modifications. Not everybody could. They were able to do more of these refinancings. Not everybody could. And that had a big effect on these things. Now, fast forward, and when you think about the new system has a lot of non-bank, shadow bank in the architecture. Does that really matter? Well, one could argue that maybe the policies that we wrote 15 years ago were archaic and we wrote simple policies and it doesn't really matter. Turns out that COVID has given us a very good way of testing whether this matters or not. In what way? Because here is what you see in the case of debt servicing in the mortgage sector. And what I plotted here is just telling you that non-banks, shadow banks, don't just dominate when it comes to origination, they also dominate when it comes to debt servicing. This is just sort of in the same ballpark proportion as what I showed you before. On the y-axis, on the right-hand side is the proportion. So that's roughly around 50%. So big proportion is in this market dominated by this. So what was the COVID shock? Well, COVID shock, we had CARES Act in the US. It was a very simple debt relief program. It was not complicated like the plans under Obama administration back in the day. because that's what people thought led to intermediary frictions mattering. So what was happening here? Well, we told people that, look, there are some mortgages where if you ask for forbearance, if you ask for debt relief, you're going to get that, no verification, nothing. You just need to request for forbearance. So you would think that this seems pretty straightforward. It shouldn't really matter whether it's a non-bank or a bank, and this architecture, why does this matter? It turns out it matters big time. So first, what I'm showing you here is this policy had a huge effect on how much debt relief was moderated in the economy. So what's being plotted is unemployment rate and delinquency rates, which typically move one by one. You can see that right from 06 till 20. But during the CARES Act, during the COVID crisis, you can see that unemployment spiked up, but delinquency fell down. Why is that? Because you can see it's been substituted away into forbearance because a lot of forbearance happened. In fact, in the US, about $70 billion of lending, mortgage lending, is under forbearance right now. We'll have to do something about it. So what does this have to do with non-banks and banks? Well, it turns out if you ask, are banks and shadow banks doing this similarly? They're not. Here is the difference between shadow bank rate and bank rate in terms of forbearance. Remember, it's a very simple policy, but if you look at what's happening, shadow banks are forbearing way less than banks. And it took a long time after the policy, which was passed in March of 2020, till shadow banks became similar to banks. And what's the reason? Two reasons. One is shadow banks are not in the business of doing forbearance, so they had no idea how to sort of think about these things. Distress is not something that they've dealt with. And number two, they did not have the adequate liquidity that was needed to do these kinds of forbearance because they operate on very thin margins. They are in the business of originate to distribute, as you all know. So they didn't have enough liquidity to be able to do this. And we sort of dig more deeper into it. So you might wonder that, okay, fine, forbearance gets delayed, but does it really matter? Well, it turns out it matters because if you look at shadow bank servicing, where they are doing, that's the left picture. And on the right hand, if you look at minority share, for example, what you find is that shadow banks are mainly operating or largely operating where minority shares are pretty high in a region. So just because forbearance is not happening by shadow banks, you may say that, well, that's bad luck. Turns out it's happening more in some regions. And as you all know, that minority dominated regions were affected more by COVID. So there is a ripple effect here, which actually is accentuated by the fact that we have an architecture which is not geared to do debt relief policies the way we think it might if we ignore the IO industrial organization of banks versus shadow banks. So in the last minute, before I sort of give the floor to Andy, there are other things which also one might worry about when it comes to fintech, for example, which I haven't talked about, but they do affect stabilization policies because fintechs are going to be decreasing the importance of local banks. There are markets and borrowers that they'll go after where risk is easier to price or willingness to pay is easier to access. So things, markets which are cookie cutter, where speed and convenience is easy, refinancing markets, these are all the places where you'll see fintechs operating. So what's the big deal? Well, the big deal is, suppose you are thinking about monetary policy like refinancing. Turns out it's dominated by fintech. Now, refinancing markets, anybody who's worked in refinancing, either in firms or households, knows there is market power with these lenders. With fintech lenders, because they are doing other things too with your data, maybe the effect of monetary policy is very different from what we think it would be if we thought that we are still in the classic banking system. The other thing is that these entities are very reliant on securitization market. Usually when we think about policy and policy pass-through like monetary policy, we don't think about secondary markets immediately. But turns out if the monetary policy pass-through is going to happen through fintech, you got to worry about securitization markets at the same time, which is a little bit different than how we have thought about these policies. And like I said before, they are reliant on thin balance sheets. So you need to worry about their liquidity position as well, which we don't do because these are not regulated entities. So let me conclude. I think I tried to argue that views based on bank balance sheet, classic view are incomplete. A lot of activity is happening outside banks due to regulation and technological changes. Banks themselves are actively changing their business model depending on their balance sheet position. Both of these margins, the shadow bank migration margin and the bank retention margin, fundamentally alter pass-through of regulation and stabilization policy. I tried to argue that there's no simple fix. You can't just scale up by looking at how much activity is outside the bank balance sheet because of various things related with industrial organization, interaction with the business model of banks and shadow banks and segments that they operate in, which ultimately means the equilibrium has to be studied intricately. Why do we care? I've tried to argue that regulation and stabilization is one reason why we should care about it. But of course, if we step back and think about the economics of what do banks do, we are essentially, dancing all around that because we essentially are taking whatever bank activity is and separating that out and trying to see if the banking system is going to operate the same way relative to when banks were doing all of these things together.
Thanks very much. That was just great. You took about the right amount of time. It was really interesting, novel. I thought it was just terrific. So let me say to everyone, the floor is now open. You should feel free to ask a question via either the chat function or the Q&A box, either one. I will be monitoring both. Let me start off with one question directly from Amit from myself. So for a long time, both nominal and real interest rates in America have been falling for various reasons. And of course, one of the big issues before the pandemic was whether the Fed was going to have enough room to engage in stabilization policies, given the low level of nominal interest rates. So you've introduced two new margins, and I find the evidence for them completely compelling. The shadow bank migration margin and also the balance retention margin. So here's the question. Does that give the central bank more or less ability in practice to stabilize shocks in your view? Because there was certainly a strong preconception beforehand that despite the Fed's protestations to the opposite, they didn't have enough margins, even with QE and forward guidance, simply because interest rates can't get very far negative. And I really have no sense for how quickly either of these, the migration or the balance sheet retention margin, move in practice. So that's a question for you, and I will switch over to monitoring the chats.
Yeah, thanks, Andy. I think that's a great question. I think I suspect that many who thought that not much was happening because of the different kind of policies Fed was passing was, again, partly because they were only looking at the banking sector. In fact, if you look over the last 10 years, and I would say it all happened pretty quickly in a span of 4 to 5 years, there was a major change in the lending landscape. And so if you attribute some of that because of the policies and regulations that Fed passed, I would say that they actually had a very big role to play in all of this. And part of the reason why they felt that maybe this was not doing much in the banking sector, it's true, it was not doing much in the banking sector, it was doing a lot outside the banking sector. And I think they have caught on to that, but it remains to be seen how they would incorporate all of these things. I think they have more levers, but it's also more complicated. I think it's certainly more complicated because how shadow banks and banks behave is not as simple, is what I was trying to convey in the talk and hopefully communicated. So more levers, but also more thinking.
Well, they've certainly focused a lot more on capital markets during this crisis. Anyway, yes. A question from Abdullah Yavas. What is stopping the private securitization market from coming back to life? If it did come back to life, would you expect shadow banks to originate more jumbo loans?
Yeah, thanks for that question. Yeah, so I think my sense is that private market collapsed in the US. For those who have followed the residential mortgage market would know this, but there was a lot of fraud that happened in this market in the previous housing boom. And somehow we have not been able to get the trust back. Also, I think the Dodd-Frank regulation was extremely onerous, at least it seems like that based on revealed preference. And essentially it never took off because we were never able to get the trust back. And I think whatever the the pendulum might have swung a bit too hard in one direction. So it's been a long time. And to your second part of the question, I do expect shadow banks to originate jumbo loans, absolutely, once it comes back, because they rely on being able to sell and don't have a balance sheet capacity. So as soon as the jumbo market becomes liquid, they absolutely will be operating in that. There's no reason for them not to. In fact, I actually think they have more data on jumbo borrowers, and they can actually offer lots of products to jumbo borrowers, because remember, these are high income, high wealthy individuals who will be more than happy to pay for convenience, even higher than what conforming borrowers might be. So yeah, I would expect this to happen soon, hopefully.
Okay, thank you. A question from Yuchen Chen. She would like to hear more about distributional consequences and the differential effects on heterogeneous consumers. And clearly that's a big part of the IO background in your model. Yeah,
so essentially the way we sort of think about this is when we are modeling the demand side, we allow the preferences to depend on different demographics. So you can think about the age, you can think about the location, you can think about other aspects as well. And what we then allow the model to do is to tell you how the demand changes depending on these different demographics. So that's the modeling bit. But when you look at the policy, think about a policy like capital requirements. So as you tighten capital requirements, what's going to happen to the banks? Well, banks are not going to use their balance sheet as much, especially on the jumbo side, because that's where all the balance sheet does a ton of work. Because on the conforming side, on the GSE side of the balance sheet, they always have an option to sell and behave like shadow banks. So if jumbo borrowers are going to be facing a huge amount of these costs that come from tightening capital requirements, you realize very quickly that distributional consequences are different for different types of borrowers. Similarly, like if you think about expanding where the cutoff of GSC market is, to Abdullah's question, another way of thinking about Abdullah's question is, hey, look, right now we have stopped the conforming market at some loan amount. Right now it's like 417,000. So forget the private market. Let's just expand the entire spectrum and just make that 417,000, I don't know, $1 million, so that every loan can be securitized through Freddie and Fannie, and then shadow banks can operate there as well. If we did decide to do that kind of a policy, you can immediately see that shadow banks will operate, banks will operate, and that will have a very uniform consequence on all types of borrowers. Fast forward to the last bit that I was telling you, for example, related to debt relief. Now, shadow banks tend to be operating. So remember, I told you about two types of shadow banks, the fintech shadow banks and non-fintech shadow banks. Non-fintech shadow banks, I didn't have time to get into this, operate a lot in the risky part of the market. So when banks retreated, they retreated mainly from risky parts of the lending market, and shadow banks, especially non-fintech shadow banks, entered there. And once they entered there, they are the ones who are also doing debt servicing. Now, why is that important? Well, I just showed you that when debt relief has to be passed, you need to have some liquidity to be able to pass the relief, because that's how this works. I mean, with the borrower. If you don't have liquidity, you will not be able to pass the debt relief. Now, if the non-fintech shadow banks are operating a lot in minority neighborhoods, in low-income neighborhoods, which is where they are operating, you can immediately see that a policy like a forbearance policy, which is supposed to affect everyone, is not going to affect everyone equally. In fact, because of shadow banks, you're going to find that minorities and low income who should actually be benefiting from this policy are going to not benefit as much. So distributional consequences work in strange ways, if you will. But yeah, you got to understand the IO consequences to be able to get at these things. So hopefully that adds a little bit more color to this. Okay, we're out of time, but let me ask one more question. So I'm relaying a question from Utpal Bhattacharya.
Till now, you have looked at conventional monetary tools. Should we be thinking of new monetary tools for this new age?
I think, Utpal, thanks for that question. I think so. When we think about QE, I don't know, QE is unconventional in some sense. I mean, now maybe it's become conventional because we've been using it for 10 years, I guess. So, I talked a little bit about QE, and I think QE, if you looked at the quantitative estimates, it turns out that QE has a much bigger bite in terms of lending activity changing, in terms of distributional consequences and so on, relative to a standard policy like capital requirements. And it's not too hard for you to see why, because secondary market policy affects not only banks, but it affects shadow banks too. So it has a much wider effect. But I think you're exactly right. I mean, we got to think about policies beyond the conventional monetary tools, because the landscape has become more complicated. The lending activity is now not just being done by banks, it's done outside the banking sector. And like I talked about earlier, there are a lot of other activities which are also happening outside the banking sector. And if we keep thinking about conventional monetary tools and thinking about how it passes into the real economy in the usual way, we are going to be more often wrong than right, because it's a very different architecture now relative to what we sort of think about even 2 decades ago.
Okay, let me just insert one last question. This is from Bernie Young. So you said that approximately 30 to 40% of the changes were due to technology, and the rest, most of the changes were due to regulation, which is spurring shadow banking. So technology relatively quickly goes worldwide. And of course, many of the regulatory constraints differ from country to country, but they almost always protect incumbents at the which become monopolistic and inefficient. Do you have any suggestions for the applicability or relevance of policies outside the United States for China, India, Singapore, whatever?
I think so, because when I, for example, think about India, I mean, China is a more complicated sort of country, I would say. But if I think about India, for example, and I think about the shadow banking sector, it's a similar kind of activity migration that has happened in India as well. So over the last decade or so, we tightened the bank screws on banks, and a lot of activity moved to shadow banks. Now, in India, the good thing is that both shadow banks and banks are under the purview of the central bank, so at least they can monitor them. But I would say that same sort of way of thinking would apply even to China. The complication, of course, is that the role of state in the banking space and in the private space is a little bit difficult to disentangle. So that's why I was saying it's a little bit more complicated to figure out what's the right IO, because if you have a central planner deciding already and moderating activity in the private and banking space, I'm not sure how to sort of think about this. But I actually think, so this is a topic which probably requires more than a 2-minute answer. My short answer is, I think this can tell us a lot about economies outside the US as well. That's why I try to emphasize that. If you don't take anything, just think about Basel requirements. When you think about Basel capital requirements, we say every bank in every country should have X, and it just cannot be, because different countries, India, China, everyone has different shadow banking sector. They have different reliance on secondary securitization markets. And if that's the case, for the reasons I have outlined, you need to think about at least Basel differently. But that's a topic for another day, I guess.
Okay, thanks. This was a terrific session. We're only slightly over time, so I want to, on behalf of everyone, we can't join in a round of applause for you, Amit, but we really appreciate your time. Thank you to everyone for attending. ABFER obviously goes on this afternoon, later on in the week, next week. But thanks to our keynoter and to Bernie Young for organizing this. And I will bid you all adieu. Be well. Thank you.